Hello, welcome to our quarterly coordinates presentation. For the second quarter of 2024, we use classic video games to help describe our outlook for the remainder of the year for the economy and various asset classes. These are the 6 topics we are going to discuss. They encompass our views on everything from the economy to the equity market to asset allocation. We visualize the economy as a game of Frogger. The US economy has been able to avoid all the obstacles in its way and has defied a lot of people's expectations of going into a recession. There have been no shortages of obstacles in our way. When you think about it, the US economy has been able to overcome a 500 basis point rate hike, which is the largest amount of tightening in the last 40 years. We have been able to overcome increased borrowing cost. When you look at credit card rates, they are north of 20%, and small business loans are more than 9%. Mortgage rates are at about 7%. When taking a look at the housing market, we have been seeing some significant declines. It is now down 36% from its peak. Some of the other things we have had to navigate through is the global economy. When taking a look at some parts of Europe, there are still some countries in a recession, and China is still struggling to get its feet under it. Also, negative sentiment in surveys despite positive data was also a drag. Ultimately, we think the US economy has been able to recover from all of these different obstacles and skirt a recession this year. Why has this economy avoided a recession? The answer is the consumer, which represents 70% of our economy. Consumers have been resilient because of these different factors. First, when taking a look at the consumer, net worths are at a record high. Historically, consumer spending does not collapse when you have record wealth. Second, we have a healthy job market. Although it may not be as robust as it was about a year ago, the data for March's employment report shows that the US economy created over 300,000 jobs. Also, positive real wages has continued to outpace inflation. Fourth reason is consumers remained less leveraged relative to previous cycles. Keep in mind that 60% of consumers do not carry any credit card debt. The point is, majority of Americans do not carry the big burden of credit card balances. Lastly, there is some insulation from higher interest rates. Although interest rates are above 7%, the reality of it is that 75% of homeowners have less than a 4% mortgage rate or own their home outright. So the uptick of rates we have seen doesn't necessarily mean you and I have to pay more for our mortgages, but it does mean we have less incentive to switch or buy another home. We expect consumer spending to downshift due to factors such as delinquencies, consumer loans slowing, and dwindling savings, but we do not expect a collapse. First, we expect the employment market to remain more resilient and not lose many jobs. With job growth being positive, a recession is unlikely as our economists believe you need a minimum of 1 million job loss to even consider a recessionary environment. Second, the spending by the government to incentivize the reshoring of security-sensitive goods like semiconductors and healthcare needs continues to gain momentum. On the right, these are the headlines we have been seeing that support business spending. We have been seeing spending packages from Washington, companies heavily investing into AI, and we are also likely to see more spending in defense with Ukraine and Israel. The point is, even if we have some softness in the consumer, a lot of it will be offset by continued spending by businesses. As a result, our economists have made a small change to their forecasts from the mildest of mild recession to the softest of soft landings. We have modestly revised our economic growth forecast for 2024 from 1.7% up to 2.1%. Now turning to monetary policy. The Fed has the ability to hopefully deliver this soft landing by nourishing the economy with a few interest rate cuts. Recently, you have seen in the news that inflation has started to tick up, but we ultimately think that this is going to prove temporary. But that tick up has really caused the Fed to sit up in their seats and become much more focused on the data that is coming out about the economy. The average length of time between the Fed's last hike and first cut is 7 months, and the Fed has been on hold for the last 9 months now. Ultimately, we believe the Fed is going to cut this year because the economy is going to have a soft patch. We can see at the chart to the left, second and third quarter are forecasted to have a slowdown for GDP. The reason that is significant is because when the economy starts to slow, that is going to ramp up the tensions on the Fed to deliver a soft landing. Now, you may hear a lot of chatter about why the Fed will not be able to cut, but when you check those comments with the Fed's past actions, you will see that many of those comments are unfounded. We are likely to see 3 interest rate cuts this year. One question investors have been asking is if the Fed is going to cut rates, what does that mean for the money market accounts that are yielding north of 5%? It is true that money market rates are likely to come down as well since they move very closely with the Fed's fund rate. However, given the Fed is going to be slowly bringing down interest rates, cash yields remaining north of 4 to 4.25% are likely to be around through the end of the year, which means you do not have to be in a rush to deploy your excess cash. It may be prudent to wait for better opportunities, and we will discuss some of those later. Now turning to politics. The 2024 elections are around the corner, and we are less than 200 days away. The economy will be a driving factor in choosing the eventual winner. You would think that the economy skirting a recession would be a positive for the incumbent, President Biden, because dating back over the last 100 years, the economy has been one of 2 indicators that have been accurate in calling the election. Taking a look to the left, the overall and simple metric is that if a recession does not occur in the 2 years leading up to the election, the incumbent wins. And if there is a recession, the challenger wins. But as you can see in the data to the right, there is a major disconnect between the actual economic numbers and the perception of the economy. As a result, this metric's predictive power could be diluted this time around, especially as the economy is the #1 issue on voters' minds. The second indicator that has a good record of predicting the winner of the elections is the performance of the equity market. First of all, the good news is that historically, the election year, or 4th year of the presidential term, has been good for equity investors, with the S&P 500 up on average 10.3% and positive 83% of the time, which we can see in the gold dotted rectangle on the chart to the left. The graph on the right shows that in the 3 months leading up to the election, the equity market has predicted 20 out of the last 24 elections. If the S&P 500 is up over that 3-month window, the incumbent wins. If it is lower, the challenger wins. At the presidential level, we believe that we are in for another incredibly tight race. Basically, the presidential election is a toss-up, but our political team gives a 70% probability of the Republicans winning the Senate, and the Democrats a 60% chance of winning the House. What's really interesting about these potential results is that this will be the first time in history that a split Congress flips both houses and remains split. Turning to the fixed income market, we use the game Ms. Pac-Man to articulate our view because the goal is to consistently gobble up the pack dots. And the good news is when you look at the current yields, which are on the dark black diamonds, they are well above the 15-year average that we've seen. More importantly, when you look at the higher quality instruments like municipals and high-grade corporate bonds, they are closer to the top of the range. In fact, the average coupon of investment-grade corporate bonds is at the highest levels we've seen since 2016. Because of this uptick in higher quality yields and the potential for some softness in the economy, we don't see the need to take too much risk with bond portfolios and invest in high-yield bonds. That's why we continue to favor the higher quality investment-grade bonds, where default rates have historically remained low. The chart on our left illustrates how high-grade bonds have much lower default rates versus the high-yield space, where defaults for more speculative companies can soar over 30%. The reason we do not see an increase in defaults in the high-quality portion is because corporate bond issuers have only seen their fundamental dynamics improve over the last couple of years. When it comes to defaults, we think there is a low probability of defaults, especially in the investment-grade space. Corporate America continues to improve the healthiness of their financial backdrop. As an example, we look at the interest cover ratio, which is basically looking at your profits and determining how many times you could afford your interest rate payments. As you can see on the dark blue line, it has gone from about 5 times back in 1991 to over 12 times now. High yield still has not gotten up to where investment grade was in 1991, as it is still below 5. Now, the one thing to keep in mind is that when you receive a higher coupon payment, it increases your total return from bonds. But if rates fall, which we believe that they will, it will only enhance your capital appreciation of your bonds. And we continue to be in the mindset that interest rates will move lower by the end of the year, with our forecast for the 10-year Treasury yield to fall to 3.75%. Like Ms. Pac-Man, bonds will have to avoid a few ghosts from the bond market. First, if there is no soft landing for the U.S. economy and it continues to grow over 3% or so, that would cause rates to go higher. Second, if we saw a resurgence with inflation, that would be a negative for the bond market and cause rates to move higher. If the Fed has to raise rates or decided to not cut them, that would also likely cause rates to go higher. The good news is that none of these factors are in our base case when it comes to the bond market. More importantly, we think the bond market is going to benefit from the fruits of a weakening economy and Fed policy. The base case is that the economy slows, particularly around mid-year. We think the disinflationary trend will continue, which will cause interest rates to lower. We believe the Fed is going to embark upon a cutting cycle that tends to drive rates lower too. Lastly, the Fed is nearing the completion of reducing the size of their balance sheet, which by definition has led to more supply of bonds on the market, and there will be a net pickup in demand as the Fed will be reinvesting the proceeds as bonds mature. So if these things occur, which we believe they will, we think the market has the capacity to improve, and we believe interest rates for the 10-year Treasury yield will fall from 4.3% to 3.75% by the end of the year.
Now, turning to equities, there's been no bigger beneficiary of the stronger than expected economy than the equity markets. We've powered up our earnings per share forecast from $225 to $240 for the S&P 500. Of these 5 factors, the main driver of that is the better than expected GDP growth and the fact that we think we'll avoid a recession. Our PE multiple remains the same at 21.5 times earnings. If you look at this graph and you remove the COVID era spike, the PE multiple is about as expensive as it's been in the last 20 years, so we don't see it expanding from here. When you do the math, $240 in earnings times 21.5 PE multiple, we arrive at our target of 5,200. Now, that doesn't represent a lot of upside from where we are today, but we do expect the S&P 500 to continue to exhibit some volatility in the near term. It's important to remember that these pullbacks are not unusual, and we view them as a healthy part of the market cycle. In fact, on average, we get 3 to 4 pullbacks of 5 to 10% per year, with the average drawdown from peak to trough being 13%. Here are a few reasons why we think this pullback is normal. One of the main reasons is time. We had gone 6 months without a pullback of 5% or more, which is double the amount of time in which we usually see that pullback. Another reason is sentiment. Sentiment was very optimistic coming into April. In fact, this was the second highest reading we've seen in history. And when we go back and look at when this reading has been this high, the returns in the following 3 months, 6 months, and 12 months have been fairly range bound. We view these pullbacks as an opportunity because we're still relatively early in this bull market. Historically, bull markets tend to last about 5.5 years, and we're currently only 1.5 years into this cycle. And from a magnitude perspective, this bull market has been very average. We think longer-term forces are in place to continue to drive momentum. We think earnings will continue to move higher. Our outlook is still for a soft landing and positive economic growth. There's still a record amount of cash on the sidelines. In fact, there's $6 trillion sitting across money market accounts. And interest rates are likely to come down across the curve and increase the attractiveness of equities longer term. When it comes to our favorite sectors, we prefer infotech, industrials, and healthcare. The reasons we like these sectors, in addition to the commentary listed here, is that these are the 3 sectors that we think will have the best earnings growth this year. And with valuations already being elevated, the only way to get your stocks going higher is to deliver with earnings. And in addition, we like these sectors that are more levered to business spending than to direct consumer spending, as we expect the consumer to slow spending as we move through the back half of the year. When it comes to market capitalization, we're looking for a broadening of performance with small cap equities performing better. Small caps are currently trading at a 30% discount to large caps, nearly the largest amount in the last 3 decades. There are 2 catalysts that we're watching. Number 1 is earnings. By the time we get to the end of this year, we expect earnings growth will likely outpace that of large cap equities. The second catalyst, as we've mentioned, is at some point the Fed will begin to cut rates. And historically, small caps tend to outperform in the 12 months following that first rate cut. Turning now to international markets. The United States has been the leader in the greatest number of game developments. We have almost 7,000 developers here in the United States, and if we look at the number of top 10 video game franchises created, 5 of them reside here in the US. As the US is dominated in the video game space, we expect the US to also remain dominant in the equity space. Some of the reasons we expect that to occur are because of the fundamentals. US growth is projected to outpace other economies, and the US is the only developed country to see its growth estimates revised higher so far here in 2024. And because of those better growth prospects, earnings are likely to remain steadier. Other countries, for comparison, have seen meaningful downward revisions to their earnings forecasts over the last year. And so it's no surprise that the sectors we favor have the largest exposure in totality in the United States. For investors with a longer time horizon, we still do like emerging market equities. From a valuation perspective, they're trading at a significant discount versus the US equity market and where they've traded historically. And we don't think that all of these discounts are warranted. When you factor in expectations that most emerging market countries like South Korea, like India, are all expected to have better earnings growth this year than the US. And a big driver we'll continue to watch is the impact from friendshoring, where companies are moving their manufacturing capabilities out of China to these other countries like Vietnam, India, and Mexico. And that concludes our quarterly outlook. As always, thank you for your trust in us. Thank you for tuning in. Have a great day, everyone.